Hi, welcome to Curious Bricks. Last week we reviewed TJX Company's earnings update. Today we're going to talk about ROST Stores, ticker symbol ROST, Q3 2020 earnings report. ROST is part of S&P 500 index under the consumer discretionary sector. The company's earnings call was hosted on November 19, 2020. Since this is our first time covering ROST, we will start with a quick overview of what ROST does and how they make money. Very similar to TJX business model, ROST is another one of the largest discount retailers, but with a focus in the US market. The company was founded in 1950 in the state of California. The company's fiscal year 2019 revenue was $16 billion. ROST's key market is in the states with the highest population, such as California, Texas, Florida, and Illinois. ROST operates under two brands, ROST Dress for Less, which represents 80% of total store count, and DD's Discounts. ROST tends to have a larger storefront and primarily targets female customers, while DD's operates with a smaller footprint and targets the younger customers. Ladies' home and men's are the core merchandise offerings. ROST's direct competitor in the North America is TJX Companies, but it also competes with national and regional department stores. Before we dive into the financial details, let's take a quick look at some key statistics. As of January 15, 2021, ROST's share price was $117, and its market cap stands at $41.6 billion. The trailing price-earning ratio is around 136. Forward dividend is not available, as the company suspended the dividend program during the pandemic. As of December 15, 2020, the short interest of total floating shares was only 1.6%. Now let's take a look at their latest quarterly financials. We will start with the income statement. In Q3 2020, ROST reported total revenue of $3.76 billion, which is 2% lower than the same quarter last year. Despite of the year-over-year revenue decline, this quarter's performance was a steady improvement from Q2. On the SG&A line, ROST reported a large one-time charge of $240 million, or 640 basis points, related to senior notes refinancing. Additionally, the company reported an incremental cost of $25 million related to COVID. In summary, ROST reported total operating income of $137 million, or 72% lower from a year ago. ROST also reported the sales breakdown by merchandise category. Home, beauty, activewear, and kids are the trending categories, while ladies and shoes showed significant decline. Now moving to the balance sheet, ROST increased its cash on hand by $3.0 billion to a total of $4.4 billion, while long-term debt increased by $2.2 billion to $2.5 billion from February. Overall, ROST liquidity looks extremely strong. In this quarter, the management highlighted that the cost of goods sold increased by 35 basis points. Despite merchandise margin was up 190 basis points, freight costs, higher distribution expenses, and buying and occupancy costs added more costs during this quarter. Pack-away levels were reported at 26% of total inventory, which is significantly less than the 39% from last year. Lastly, the company completed its 2020 new store openings with a net increase of 54. During the Q&A session, several analysts inquired on the low inventory figure reported and asked whether the inventory is sufficient to support upcoming holiday shopping season, as well as the spring season next year. The management sees overall supply availability is plentiful, and the company has the right amount of inventory and assortment. The company approaches this holiday season very cautiously, especially with the recent upsurge restrictions. The company will balance sales with managing the business, managing the liquidity, and managing the inventory. There's a chance that the company may lose sales, but the management will still decides to take a very cautious approach. One analyst asked about the supply chain challenges. In Q2, the biggest challenge was staffing in distribution centers, but that was resolved through increasing wages and providing proper incentives. The current supply chain challenge is on port congestion, which adds cost pressure related to increased freight costs. A couple of analysts also inquire on the new store opening plan for the next couple years and whether there will be a ramp-up process. The company usually opens 100 new stores per year, 80 ROST stores and 20 DDs, but given the current pandemic situation, the management will not provide guidance until the year-end conference. Lastly, one analyst also asked whether the dividends will be reinstated. The management responded that currently the near-term focus is to preserve liquidity, so the board will wait until after the holiday season. Now let's take a look at ROST stock performance before and after the earnings call. ROST reported revenue of $3.76 billion, beat analyst expectation of $3.43 billion, but its adjusted EPS of 37 cents fell short of the consensus of 61 cents. On the following trading day, the market had a negative reaction after the earnings announcement. Lastly, here is the latest summary of analyst ratings of the company. As of January, there were 25 analysts covering ROST. Nearly half of the analysts gave the rating of buy, while the others gave either strong buy or hold. If you are interested in knowing more about this company, I recommend you conduct further analysis of the company's public filings. Thank you for watching this video. If you like this video, please subscribe to our channel.